Thanks, Rishi. Good afternoon to all of you. Thank you for joining us here in person. Very happy New Year to each one of you. Our revenue grew 1.7% quarter on quarter and 6.1% year on year in constant currency terms in Q3. All verticals and most geographies grew year on year. We saw double-digit growth in Europe and India and in our manufacturing business. Large deals were at $2.5 billion, operating margin at 21.3%. Free cash flow for the quarter was at an all-time high of $1.26 billion. Headcount grew by over 5,000 sequentially, where we are now over 323,000 employees worldwide. Financial services in the US continues to grow strongly in this quarter and over the past few quarters. We've seen a revival in European financial services during Q3. We are seeing an improvement in retail and consumer product industry in the US, with discretionary pressures easing. Automotive sector in Europe continues to remain slow. In generative AI, we have built 4 small language models for banking, for IT operations, for cybersecurity, and broadly for enterprises. In generative AI, we are also developing over 100 new agents. These agents are for deployment within our clients, many of them already using agents that we've developed. Based on our strong performance in this quarter and our view for the rest of this financial year, we are revising our revenue growth guidance to growth of 4.5% to 5% in constant currency terms. Our operating margin guidance remains unchanged at 20 to 22%. With that, let's open it up for questions.
Thank you, Salil. We will now open the floor for questions. Joining Salil is Mr. Jayesh Sanghrajka, Chief Financial Officer, Infosys. The first question.
On the first, I think the sort of view in Q3 and it was the growth at 1.7%. What we saw was, the last quarter we had seen discretionary becoming good in financial services in the US. Now this quarter we have seen financial services in Europe, also the discretionary showing signs of improving, and on retail and consumer products in the US is showing that signs of improving. So that coupled with how we delivered in the quarter was the reason where we changed the guidance to increase. Now the second I think was about, if that is the guidance, what is the Q4 and so on. So there, first, as we've always shared, our Q1, Q2 in a typical financial year are strong. Our Q3, Q4 are typically weak. So that's the sort of seasonality that we see in Q4, nothing more or less. Jayesh will give a little bit more color on some of these points. On the hiring that you mentioned, there I'll say a few words and I'll pass it on to Jayesh. We've had a strong hiring in Q3 with this expansion of over 5,000 employees. And we see that based on some of the discretionary, this will continue, but it will have seasonality as we see in our revenue. For the next financial year, we are obviously not giving the growth guidance, but what we do see is that many of the things we've put in place across the whole company, focus on large deals, focused on small deals, focused on artificial intelligence, making sure we're doing cost takeout for clients. All of these things combined are helping the company to execute as well as it's doing. So let me pause here if there's anything else.
How much of it was organic, how much inorganic because of the Intech acquisition, that as well?
So Intech, let me just answer that and I'll go back to other questions. Intech was last quarter, we had pretty much 2.5 months of Intech. So this quarter, the Intech was roughly around 20 bips in revenue. Coming back to the other points, if you look at large deals, our large deals, while the overall large deal number you will see is remaining same, Within that, the net new has increased significantly. So last quarter, our net new was 40%. This quarter, our net new is 60%, which means that the large deals per se, or the net new TCV of the large deals have gone up 1.5 times, between Q2 and Q3. Our large deal pipeline has become stronger, as we see. So all of that has led to our increase in guidance, just to add to the points that Salil was making. Coming to the other question on comp, we had announced earlier that comp will happen in 2 phases. One phase from 1st January, the other one will happen from 1st of April. We are on track with that. The first part of the comp is getting rolled out in this quarter, and we are working with HR on that. So our HR team is working on that.
The question rather was, what will be the impact on margins?
We
if you
don't
could guide
define the
us?
impact on comp, exact impact on the comp in terms of margins. So we will have some headwinds coming from the comp in Q4 and Q1 based on it. But broadly, the comp that we are expecting is 6 to 8% in India, and the overseas comps will be in line with the earlier comp reviews.
I think, Salil, the question on discretionary spends on high-tech, telecom, some of these areas that you'd continue to flag in the last quarter, if the outlook on that is improving, and if the BFSI momentum you expect to continue into the new year.
So on high tech and on telecom, we've not seen a change. What we've seen the change is really on financial services, more in Europe, and on retail consumer products in US. Will it continue at this stage? That's what we're seeing in terms of what we saw in Q3, but we'll wait and see how it looks beyond.
Thank you.
This one was on the discretionary. The budgets for our clients will be on a calendar year basis, which will start now. So we'll get a sense in this quarter itself. Our commentary is mainly on what we've seen in Q3 and how the discussions have been going. And that seems to indicate the changes that I mentioned. In terms of the new changes in the US, we'll wait and see how it goes. Generally speaking, most people who are the economists and so on have a view that the economy there will do better. That's what our clients are saying. But we'll wait and see how it goes. We have a business that works in those growth situations, in the cost situations. So we're feeling quite confident in terms of the outlook there.
So what's the dependency on the H-1B visas? Do you see any impact there?
So there, maybe you want to go?
Yeah, I can answer that. So if you look at, over the years, our dependence on H-1 visas have reduced significantly, right? First and foremost, our on-site mix has reduced significantly. We used to be in the 30% range. We are now at 24% range. Within that, our nearshore has increased significantly. And within the on-site, the US on-site population that we have, our H1 independent folks are now 60+%. So we have now built a pretty resilient model from that perspective, and we are therefore much more confident from where we are versus where we used to be earlier.
The other question there on attrition.
Yeah. So coming back to your other questions, attrition at this point in time has remained at 13.7, which is one of the lower attrition that we have seen in the last multiple years. It's range bound, and we don't see a challenge there at this point in time. We have already added last 2 quarters. We have added net new employees, and our campus hiring program is also as per our plan. So we don't really see a challenge there as well. You had another question on margins. So if you look at our margins this quarter, we have expanded our margins by 20 basis points during the quarter. And if I just take the puts and takes of that, 40 basis points came from currency benefit, both rupee depreciation as well as the cross currencies. 20 basis points came, 30 basis points came from a Maximus, mainly from the pricing benefit that we got. 20 basis points came from the expected credit loss provisions and lower provisions on post-sale customer supports, offset partly by higher third-party costs that we had. And the headwind of 70 basis points was furloughs and lower working days and other costs. So that's our margin work for the quarter. As we get into the next quarter, we will have headwinds coming from the compensation increase that we have rolled out already. So that would be a headwind. Currency, we'll have to see how it pans out. At this point in time, looks like currency will give us some benefit in terms of margin, but we'll have to see how the currency progresses through the quarter.
Thank you. The next question is from the Economic Times, Bina.
Hi. Um, I want a question on the hiring commitment. I think you'd committed to 15,000 to 20,000 freshers. Is that on track? And how much have you hired so far under that? And what's the outlook for the next fiscal? And if you can just give us maybe this calendar year as well. What's the sort of hiring that you're looking at, both freshers and overall hiring? On the deal momentum, just if you could just give us a sense, which sectors are likely to grow in the next 2 quarters, while financial services is seeing a lot of pickup. Could you delve into the other segments as well? And with the deal cycle closing, a lot of other peers have said that that is sort of shortening. If you could also give us some sense on how the cycle has been, and how is the large and mega deal pipeline going forward for the next near term, maybe next 2 quarters. And the last thing, what sort of impact do you see because of the recent lawsuit that has been made public, in one of your court filings? What is the business impact because of that lawsuit? And could you give us some color on, the charges? Because I think some of it is very serious. So that's it.
You want to start off with the headcount?
Okay, so if you look at the headcount, we are on track in terms of headcount or the fresher hiring this year. We will be hiring 15,000 plus. We are expecting for FY26 at this point in time 20,000 plus fresher hiring. We do not really give an outlook in terms of the lateral hiring that is dependent on multiple factors. You know how the demand grows, how the attrition pans out, etc., etc. But and it's also a factor that over the years we have now moved to a very agile hiring model. So we can pretty much fill it this in India in 2 to 3 months, on site in less than a month in terms of the demand. So we don't really therefore give out an overview or outlook in terms of the lateral hiring. But in terms of freshers, 15,000 plus for this year and 20,000 next year is what we are looking at this point.
In terms of the industry and the next few quarters, as you mentioned, so we don't give industry specific views which are forward. We have that overall guidance which we've increased. We've given a view more on what we've seen in Q3, and we think that is something that's a good sign, because financial services, which was strong in the US, is now strong. The discretionaries come back in Europe, and with the retail and consumer products expanding. Beyond that, manufacturing still remains slow, and the other industries are at the same place where they were. So that's the way we are looking at it. But incremental, we see that it's a better situation in Q3 than what we saw in Q2. In terms of the large deals and the pipeline, a pipeline is strong. We typically don't give the value of it, but it's a strong pipeline with large deals and some mega deals. These are deals we feel good about, given the way that some of the conversions have happened. In terms of the timeline of the closure, the deal timeline, we've seen essentially similar situation from what we saw in Q2. That is where we are, except which is not just on the large, it's on the discretionary, where in those few industries that I mentioned, the discretionary moves a little bit faster, but the large deal movement is about the same in the pipeline. And in terms of any of the legal things, we have no additional comments here.